Welcome to this explainer. Today, we're diving headfirst into the massive, record-breaking surge in gold prices. We're going to break down exactly what's driving these historic market moves, and most importantly, we'll help you figure out if gold actually belongs in your own portfolio right now. Let's kick things off with a pretty staggering number, $4,967.48. That was the recent all-time high price for just a single ounce of gold, hit during a wildly volatile Friday in July of 2026. And to really wrap our heads around the sheer scale of this anomaly, consider this. Gold is up around 80% over the past 12 months. That puts this precious metal deeply, deeply into uncharted territory. Honestly, market forecasts that looked incredibly bold just a year ago have been completely run over by reality. So here's our roadmap for today. First, we'll look at the record-breaking gold surge. Second, the broken financial compass. Third, the central bank gold rush. Fourth, geopolitics and de-dollarization. Fifth, the U-shaped portfolio hedge. And finally, number 6, should you actually buy? All right, section 1, the record-breaking gold surge, a year of extremes. Let's look back at the timeline, because it's been a relentless roller coaster. In January 2026, gold soared, crossing an intraday peak of $5,500 an ounce. By March, the market cooled off a bit, establishing an intra-year floor right around $4,170. But then, fueled by tariff threats, shifting interest rate expectations, and a ton of geopolitical uncertainty, it rallied right back up, hitting a confirmed all-time high of nearly $4,968 in July. Moving on to Section 2, the broken financial compass, when traditional rules fail. According to the old-school financial textbooks, gold absolutely shouldn't be surging right now. To understand why, we got to talk about a crucial concept, the real interest rate. This is the genuine return you can get from risk-free government bonds after you account for expected inflation. Historically speaking, gold prices and real interest rates have a very strict inverse relationship. Because physical gold yields absolutely nothing in interest, when the real return on safe bonds is high, bonds usually win out, and gold faces some really heavy headwinds. But here's where things get crazy. If we contrast that traditional rule with the reality of 2024 to 2025, real yields averaged 1.97%. That is the highest since 2007. By conventional logic, gold should have tanked. Instead, it inexplicably rose more than 65% during that exact same window. The traditional model just experienced its biggest stress test in decades, and, well, it seemingly broke. So what exactly changed? Section 3, the central bank gold rush, following the whale buyers. So what broke the compass? It all comes down to a massive structural shift in sovereign demand. Central banks are buying up gold at historic, unprecedented levels. We are talking about over 1,000 tons purchased annually between 2022 and 2024, and another 863 tons in 2025. To put that in perspective, that's nearly double the historical average of the entire previous decade. Because central banks buy physical gold to diversify their reserves, not to chase yields, this massive wave of demand establishes a persistent price floor for gold, and it operates entirely independently of whatever interest rates are doing. And what's super fascinating here is that this isn't just some random scattershot global trend. This is a highly concentrated strategic move by a specific set of emerging market economies. Russia holds nearly 1,900 tons. China is right on their heels, with Turkey and India also accumulating massive stockpiles. This is a very deliberate choice by specific countries with distinct economic positions. Which brings us to Section 4, geopolitics and de-dollarization, the weaponization of finance. Why are these specific nations hoarding physical gold like there's no tomorrow? Well, the data shows a clear pattern of geopolitics driving this behavior. We've seen U.S.-Iran tensions directly spiking global inflation, but more importantly, U.S. sanctions have engineered deliberate dollar shortages. After the Iranian rial literally collapsed to 1.4 million per U.S. dollar, and after watching foreign reserves get frozen during recent global conflicts, a lot of governments learned a stark lesson. Significant dollar holdings are an exposure that can be weaponized against them. So they're actively hunting for alternative assets that foreign authorities simply cannot freeze. The macroeconomic fallout from all of this is a truly historic shift. The US dollar's share of global central bank reserves has slipped down to just under 58%. For context, that sat at over 70% back in 1999. In a huge milestone, global official gold holdings have drawn to near parity with foreign official holdings of U.S. Treasury securities. Make no mistake, the global monetary system is becoming much more layered. Our sources sum up the crux of this shift perfectly. They note, gold serves as a form of geopolitical insurance. Treasury holdings and access to SWIFT can be frozen at any time. That's the unique appeal of gold for these central banks. It's complete neutrality. It's no one's liability, and physical gold stored securely in a domestic vault sits entirely outside the global digital payment systems. Section 5. The U-shaped portfolio hedge. How gold actually behaves. Okay, let's pivot away from global microeconomics and look at actual market performance. Research shows that gold actually has a pretty counterintuitive U-shaped relationship with equity markets. It delivers its absolute strongest gains at the extremes. On the left side of the curve, it acts as a flight-to-quality safe haven during really sharp stock market crashes. On the right side, it actually participates in risk-on rallies during exceptional equity bull markets. But right there in the middle, during your ordinary, mediocre stock environments, gold's performance is far less pronounced. This actually completely busts a very common myth. You know, gold is often sold as this perfect short-term shield against inflation, like it's going to perfectly track your grocery bill year over year. But the research clarifies that's really only true over very long decades. Gold's actual functional job in your portfolio is diversification. Because it has a low correlation with stocks and bonds, it acts as ballast. It cushions the blow when your other assets fall. It is portfolio insurance, plain and simple. And finally, Section 6. Should you actually buy? So let's bring all this high-level global data right down to you, the individual investor. With headlines flashing record highs of nearly $5,000 an ounce, the big question is, does gold actually belong in your personal portfolio right now? Our sources lay out a really pragmatic, percentage-based framework, depending on where you are in life. If you're young with a high risk tolerance and a long time horizon, you might look at a 0 to 5% allocation. Your time is your true hedge here. If you're mid-career, a 5 to 10% allocation is your classic diversifier band, perfectly balancing growth with protection. And if you're nearing retirement, a 10 to 15% allocation really earns its keep as a sequence of returns cushion. It helps prevent a sudden market crash from wiping out your nest egg right when you need to start withdrawing cash. Now, if you do decide to carve out a slice for gold, the consensus advice is crystal clear. Avoid the trap of leveraged and futures products. Those are built for short-term trading, and they financially decay over time. Instead, you want to stick to simple, liquid, and low-cost physical gold ETFs and keep them in tax-sheltered accounts to get the best long-term efficiency. I want to leave you with this powerful thought from our sources. The most common mistake isn't owning gold or skipping it. It's buying it for the wrong reason, buying insurance after the fire. Look, seeing an 80% run-up naturally triggers some major FOMO. But you have to remember, gold is a strategic anchor. It's not a growth engine that you should blindly chase at the absolute top of the market. Decide your allocation in advance, stick to your strategy, and just let the market swings work for you. Will these central bank whales keep pushing the floor higher, or is a massive correction on the horizon? That is the million-dollar question every investor needs to weigh carefully today. Thanks so much for joining me on this explainer, and we'll catch you next time.